Should we be
Good morning.
doing something?
With Transamerica, and appreciate the opportunity to come here and share a little bit of time with you folks and talk about the 401k plan. The folks that are on the phone that are logged on, can you hear me okay?
Yes, I can.
Okay, perfect. Good. All right, I'm going to take silence as yes. Obviously, we're here to talk about the retirement plan benefits that you folks have available through your employer. And so what I thought I'd do is spend some time talking about how the plan works, why you should join, the benefits, and then how you get enrolled, talk about the investment options, and then how do you manage your account going forward. And certainly in between now and when we wrap up here, any questions that you have, just raise your hand, interject, stop me. This is really, your time, and so I want to make sure that you folks can walk away and feel comfortable understanding how the plan works, feel comfortable with the decision about participating in the plan and the investment options and how to access your account. So, sound like a good plan? Sure. Perfect. Okay, good. So really, the idea of the 401k plan is to save for your retirement. And you may hear a lot of discussion about retirement readiness in the news, in financial publications, and really, what the thought is, we as Americans have not saved enough to have a secure retirement. And it's up to us to take control and ensure that, we have the lifestyle that we want at retirement, that we're able to, pay for everyday expenses, do the things we want to do, cover health care costs. That's a newer concern that we all have to be aware of. So hopefully you've spent some time thinking about, what are your financial dreams. I know when we're younger, seems so far off. It's like another person. That's not me. But you really need to kind of put yourself in that place mentally and say, okay, when I'm 65 or 68 or whatever that age is, what is the lifestyle that I want? What are the things that I want to do with, my significant other, with my family, friends, whatever it may be, and then start to plan now so that when that time comes, you'll be able to, live those dreams. And so, understanding how much it will cost in retirement is important, and, preparing now, obviously, the sooner the better is the way to go. The reality is we're all living longer, and things are becoming more expensive. And obviously, advancements in medicine are the primary driver to our life expectancy. And you look at the cost of a cup of coffee today, about $2.50. Depends on where you go and what you get and how much good stuff you put in there. But, it's estimated based on inflation in 30 years that same cup of coffee is going to cost well over $6 just for a basic cup of coffee. Look at the cost of a movie ticket, pair of jeans, and so on. You just think about, your own life from, maybe 5, 10, 15 years ago, what it costs for a gallon of milk or a gallon of gas, and what it costs today. Inflation is real, and things just continue to go up in price. So the idea is we need to outpace inflation, or at least keep up with it. Wrong way. We talked about the average life expectancy. Right now it's about 77, almost 78 years. It's believed that there's someone alive today that will live to the age of 150. So you think about what retirement used to be, right? When Social Security was started back in the 1930s, the average life expectancy was about 67, and someone would retire, they'd have a few years in retirement, they'd pass on, and they had Social Security and typically their pension from their employer, and they were able to live a comfortable life. Today's environment is much different. We're all living well into our 80s and 90s for many folks, and that idea of retirement has changed, right? There's no longer the idea that Social Security is going to take care of me. Most employers no longer have a pension plan, So it's creating multiple streams of income that are going to help us achieve our dreams. One of those is going to be Social Security. There certainly will be some sort of payment made out to all of us. But you're going to need to do things like save on your own and utilize the 401k as a primary vehicle for your savings. This is what I just talked about, right? Where's that retirement income going to come from? Certainly Social Security, personal savings, and then we believe one of the best places is your 401k plan. So getting started is as simple as 1, 2, 3, and this booklet is designed with these 3 simple steps, so we're going to take you through those very quickly. Understanding what is a 401k plan. How many of you have actually participated in a 401k plan before? Perfect. Good. Okay, great. The idea is you make contributions on a pre-tax basis, right? So the contributions get deducted from your pay before any taxes, so there's some tax advantages, and we'll go into some of that detail. And then you're also making periodic, regular investments, and so you're able to take advantage of a concept called average, help me out here. Yep, so we're buying investments at various times in the market when prices go up and down, so our average cost throughout that period is going to be lower than just trying to time the markets. Thank you. Dollar cost averaging. There you go.
You literally are investing like every month, so because you can't predict where the market is going to be. So as an average, you're going to be hitting more of the high points. That's the concept.
So just to kind of give you an idea of the tax savings, let's say you put $1,500 into the 401k plan. You're at a 15% tax rate. Tax savings is $225. Doesn't seem like a lot, but I'd rather have that $225 in my pocket than in Uncle Sam's. And obviously, the more you save, the greater tax advantage you're going to have with that. There's also something called a saver's credit. So if you fall within one of these income brackets, depending whether you're single or married, filing head of household or jointly. In addition to that, tax deduction. So again, if I make $30,000 a year, I put $2,000 into the 401k. I only pay taxes on $28,000. Again, if I fall in one of these tax brackets here, I also get a credit, and this percentage is the amount of my contribution. So if I fall into this little category here, I get 20% of my contributions as a tax credit. So if I owed $1,000 and I put $1,000 into the 401k, I'd get a $200 credit towards that, so my actual tax bill would only be $800. Let me give you a little bit of an example of what that looks like. So in this case, I'm making $40,000 a year. I'm going to contribute 3% of my pay. So what's the math there? 4 times 3 is 12, all right, $1,200. No trick questions. So again, if I look at what my taxable income is, if I don't contribute the full $40,000, if I'm making that $1,200 contribution, it's $38,800, and actually that additional savings there is the tax credit. So here's our federal income tax, $5,600 versus $5,180. And again, I'm getting a 10% tax credit of $120.
You also get the state tax.
Yep, so this is just federal. So again, because we have state income tax here in California, there's also a state tax advantage as well. So again, we're going to save, a pretty decent amount on our taxes here, plus we're saving for our retirement, and then that money is growing on a tax-deferred basis. So if you were to put that $1,200 in just a normal savings account that's earning interest, or a brokerage account that you're investing outside of a 401k plan, those earnings are taxable. And so within the 401k plan, you defer those taxes until you withdraw it at a later time. So not only are you getting the tax advantage of reducing your tax liability today, your money's going to grow on a tax-deferred basis as well. Does that That make sense so far? So let's talk about how your plan works. And I know the folks that are on the phone don't have these booklets in front of you, so hopefully this will make sense. But if you open up your booklet to page 9, we'll talk about how the plan works. I'll step over here so the folks on this side will see me. Talks about your contributions. So you're able to put up to the federal limit, which for this year is $17,500. That's the maximum. If you're over age 50, you can do what's called a catch-up contribution, which is an additional $5,500. To be eligible to participate, you need to have 2 months of service. I would assume everybody here has got at least 2 months of service. Okay. And then your entry date is the first day of any month. So as long as you've been here 2 months, the first of the next month, you can start contributing up to $17,500. And again, if you're over age 55, that catch-up of an additional $5,500. You can change your contributions on a monthly basis. So if you start out at, let's say, 8%, and you think, gosh, you know, I can do that, you get your first paycheck and, oh, that's a little too much, we can back that down. Or the other way, right, you start off small, 3%, and you say, that's no problem, I can do more. Put 4%. So you can change that on a monthly basis. For those of you that may have participated in a 401k plan with a prior employer or maybe have an IRA elsewhere, if you'd like to consolidate your assets in one place, you can do that with the 401k plan here. The plan does accept what's called a rollover, and there's a form in here, and I'll go through that as well. Talks about vesting here, so the money that you put in out of your own pay, you're always 100% invested. That means you own those funds 100%, always yours. You decide to leave the company, retire, terminate, whatever it may be, you take those funds with you. Make sense so far? Okay. How do you get your money out once you put it in? Well, there is something called a hardship withdrawal. And what this is designed for is in case you have an immediate need for the funds, and there's several things that qualify as a hardship. One of those is to prevent eviction from your primary residence. Also to purchase your primary residence. So I've seen folks use this to help with a down payment, for advanced education for you or your dependents, and for medical expenses for you or your dependents. So again, if you're saving in the retirement plan and you have a need for one of those big items, you have the ability to pull the money out. I will let you know, though, if you pull the money out using the hardship withdrawal, there are some tax consequences. So not only are you subject to ordinary income taxes on the amount you withdraw, but also an early withdrawal penalty if you're under the age of 59.5, which is an additional 10% of the amount withdrawn. So think about this, you know, maybe as a last resort, or again, if something comes up where you really need it, you've got access to your funds. Obviously, when you leave or retire from the company, the money's yours. You're able to take it out. You can have it paid out to you directly. Again, if you do that, you'll have the tax consequences. You can roll it to an IRA, which is a better thing because then you defer the taxes. Or if your new employer offers a 401k plan, you can roll it into that new employer's plan as well. Any questions so far?
What do you mean by tax consequences? Can you elaborate on that term?
Yep. So let's say you work for the company for 2 years. You have a $20,000 401k balance. You decide to leave. You have that money paid out to you directly versus rolling it over. You're going to be subject to ordinary income taxes on that $20,000, plus if you're under age 59.5, an early withdrawal penalty of an additional 10%. So again, if you're leaving the company, the better thing to do is roll it over to an IRA. You don't have those tax consequences, or roll it over to your new employer's 401k plan.
And on the loan, how long can you keep the money in the loan? The loan provision? 1 year, how long do you have to pay the loan?
Do you guys have a loan? I don't think you have a loan provision.
Just hardship.
Just the hardship, yeah. Yep.
There is no loan provision
no loan
on that?
feature. Yep.
But in standard 401k, mostly they provide a loan feature. It's a company-based plan, that's why it doesn't have it?
Right. So the loan feature is an optional feature that may or may not be made available. In your plan, there is no loan feature.
And the
Just
tax,
hardship.
And when you take out the amount, is the tax liability will be held by the company or it will be given to you?
Yeah, you can have, thank you. You can have withholding done. And so, you know, if you were to take a distribution, you can have federal and state withholding done to offset the income tax liability, if you like. I don't know if that's the question you were answering.
No, the question is that when I'm taking money out from the 401k.
Oh, okay, yep.
And it's in a transit to the new IRA or a new 401k plan.
Right.
Till then, I have the check, suppose.
Yep.
If that check will exclude the tax, that that makes the company liable for my taxes, previous company, or I will get the full amount and I will become liable for my taxes.
Again, you have the choice of having withholding done or not.
Okay, so I can have the full money taken out.
Right.
Because most probably it's going to go to the next plan.
Right.
So nobody going to paying the tax.
Sure.
If the company holds it, then
Yep.
I have to communicate again and
So-
get that money too.
So yeah, so here's the, when that happens, make sure you talk to somebody, because if you do a direct transfer, then there's no tax consequences. If you do, if you have the check made payable to you, there is a 20% mandatory withholding. And then when you roll that over to the new company, you have to make up that 20% out of pocket. You'll get it back when you file your return at the end of the year,
Oh, I see.
but you'll end up out of pocket.
Oh, okay. I saw that one in a brochure. It's mentioned that the check should be payable to the Transamerica company,
Right.
not
Yep.
to your
Avoid
personal
that.
name.
Exactly.
To avoid that.
Yep.
Isn't there a 60-day window?
There is. Yep.
There's actually a 60-day window between you receiving the check and then choosing to invest it in another tax-deferred IRA program. So you have a but you don't want to go through that. You know, it's cleaner just to transfer it to the institution that you're going to be going with.
Okay.
You know what I'm saying?
If you want to keep that amount to your existing plan, suppose, like this one, and you are no longer with the company,
Right.
will it be allowed or not to be allowed?
Depends on what your balance is. The way that the regulations are written, if you have a balance of less than $1,000, the company can just cut you a check. If it's between $1,000 and $5,000, they can force it over to an IRA rollover. And if it's above $5,000, then you have the ability to maintain it within the plan until you retire.
Oh, okay. And all the privileges of the account, whatever, is still the same.
Exactly.
Okay.
You're just not able to put new money into it.
Yes, of course.
Any other questions about how the plan works before we move on and start talking about the investments? Pretty straightforward. So we talked about saving, and you know, one of the most important things is starting early. And this is just a little chart that shows, you know, how that can work to your benefit. Using, you know, the time value of money and that compounding effect, starting as early as possible is one of the best things that you can do. And what this chart shows is, let's say you have that a monthly income of a little over $2,000. If you make a monthly contribution of $125, you start that at age 25 through the age 65, you'll have a balance of a little over $250,000. If you put that decision off and you don't start saving until the age 45, you got a little less than $60,000. So you can see how much of a difference that makes, and then this just translates to what a monthly payout would be for you in retirement. So the idea is, you know, starting as early as possible and being able to save as much as possible. And again, this is just another example of the power of compounding. If we have two individuals, Ann and Tracy, Ann is 21, and she starts contributing right away, and she does that for 14 years, she'll accumulate $21,000 of her own savings. Tracy doesn't start contributing until the age 35, and she does that for 35 years, so she contributes a lot more, right? More than double than what Ann does. But because Ann started early and she utilized that time value of money and that compounding effect, when they both reach age 65, Ann is going to have a tremendous amount more than Tracy because she started early. Even though she saved less, she used that time value of money and that compounding effect. So again, start early as possible. Start now. Don't put that off. and that way you'll have that money starting to grow and compounding snowball for you as well. So let's talk about the investments. If you don't mind turning to page 17. So what I see a lot of folks do when they make investment decisions or they put money in their 401k plan is they don't take the time to understand what their risk tolerance is. And so if you're a conservative investor and you don't really know that and you put your money in a very risky investment, when that investment loses value, you're not going to be able to sleep at night, your stomach's going to hurt, and you're just going to pull your money out, put it back into the mattress, if you will, put it in that money market, and you're going to have a very bad experience, you're going to have bad returns. So it's important that you understand what your risk tolerance is. And on the flip side, if you're an aggressive investor and you're putting your money in, let's say, the money market fund, you're not getting the return that you probably could have if you were invested appropriately. So page 17, 18 talks about the various asset classes, and I'll take you through those. One of the most important things that I would suggest that you do is on page 19, is there's a risk tolerance questionnaire. And it's only 5 questions. It'll probably take you 2 to 3 minutes to do. Answer the questions truthfully, and this will help you figure out what type of investor that you are, whether you're conservative, whether you're aggressive, or somewhere in between. And so all you do is answer the questions. You'll get a point score for every answer. You tally that up, and then based on your total, we'll tell you what type of investor you are. So let's say I went through this, and my score was 15. That puts me in the moderate portfolio. Well, what does that mean? If you flip the page, on page 21, you'll see some pie charts. And this might be useful for someone who's wanting to build their own portfolio. So if you want to, do some research on the investments, build your own portfolio, this might be a guide that you can use. So for each of those scenarios, there's a sample allocation. So again, that moderate allocation right there in the middle says that I should have 40% of my assets in bonds, 15% in large mid value, 10% in small companies, and so on. Well, how does that translate to the investments in your plan? Well, if you flip the page, starting on page 22 is the list of investment options. And the way that these are organized is the most conservative investment is listed first. So that's that cash equivalent, which is the Transamerica stable value. This is very much like a savings account at the bank. You put $1 in, you're always going to get your dollar out, plus some interest. Right now, interest rates are very low, so it's not paying a whole lot, but it does have a positive return, which is a good thing. And this might be part of your overall strategy of utilizing a cash or money market type investment for that capital preservation. Again, you put $1 in, you're always going to get $1 out. The next investments are what's called fixed income, bonds. These are slightly more aggressive, but still a conservative investment. You have the Loomis Sales Investment Grade Bond. It's an intermediate term bond. The way that bonds work, they're very much like an IOU. Bonds are issued by companies. They're issued by government agencies and our federal government as well. If I buy a bond, if you will, from a company, let's say Coca-Cola, I give them $10,000. They give me an IOU. I promise to pay you back that $10,000 plus interest. So we call it a coupon. And at the end of whatever the period is of that bond, I'll get my $10,000 back plus that interest, the way that bonds work. And so again, this Loomis Sales invests in corporate bonds, various companies, and again, it's a relatively safer investment. It's interest rate sensitive, so as rates go up, the price of these bond funds will go down, and as interest rates come down, the price of those bond funds will come up. So interest rates have been coming down over the last several years. These bond funds have gone up in value. They've appreciated. If you think about where interest rates are going or where folks think interest rates are going up, again, it's that inverse relationship. The value of these bond funds may come down as a result. Just keep that in mind. You also have a high-yield bond fund. Thank you. The AllianceBernstein. This invests in smaller companies, not the Coca-Colas, but they're not mom and pop. They're going to have a higher coupon rate. It means they're going to have a higher return, if you will, a little bit more risk than the intermediate term bond, and that's why you'll see the higher return as well. You have a balanced fund, that American Funds Balanced Fund. This is going to invest in a basket of stocks, bonds, and money market. So this is a nice place to put your money that's going to be diversified, but it's a static allocation. It doesn't change. I'm going to skip these target maturity series funds for just a moment and go over to page 23. And you'll see you've got a large cap value fund, a mid cap, some large blend, mid blend, and so forth. So again, these are all equities. They invest in individual stocks of companies, and these are going to be more risky as we go down. Obviously, the larger company stocks like the Coca-Colas, the IBMs, and Microsofts are going to be much more safe, if you will, than maybe a startup technology company, and that's what the small company stock funds are going to invest in. If you flip the page on the next page, on page 24, you'll see you have some international funds or foreign. There's a couple there, the American Funds Euro-Pacific Growth and the Vanguard International Value. These are going to invest in companies outside the U.S. globally, so if you want some international exposure, you can utilize those. And then we have a couple of specialty funds, the American Century Inflation Adjusted Bond. This is another fixed income or bond fund that tries to hedge inflation, if you will. So they're going to try and outpace or keep pace with inflation using a bond portfolio. Then you have a utilities fund, that MFS Utilities Fund. The SSGA is emerging markets. So again, this is international. These are the emerging countries. And then you have a real estate fund, that Vanguard REIT Index. So you've got a really nice array of investment options. If you go back to that pie chart that we were discussing on page 21, and you notice that sample allocation, everything is color-coded. All the investment options that we just went through are also color-coded. So if you wanted to use this as a guide, again, you'd say, okay, 40% bonds, kind of a light gray. If you flip the page over, those bond funds that we were talking about, that Loomis Sayles Investment Grade Bond Fund, is that light gray fund. And if you wanted to use this as a guide, you'd put 40% of your account in that fund, and then you just go down the list. It says 15% large mid-value. It's kind of a darker gray. And again, on page 23, you've got several options there as well. Yes?
Why is it the suggested investment period goes down as it's more conservative, goes up as it's more aggressive?
Typically, the longer time horizon that you have, the greater risk that you can take.
Oh, and it equalizes in case there's a problem.
Exactly, right?
Gotcha.
Because if you look at market trends over the long term, they're typically up, even though within those years you're going to have ups and downs. And if I've only got 5 years till retirement, if there's a big downturn like we had in 2008, I'm not going to have the time to recover as if I had 20 years to save. And that's why generally as you get older, closer to your retirement age, you're going to want to be more conservative. Okay. Great question. So I skipped a set of investment options, and I did that on purpose. If you're the type of individual who doesn't necessarily want to take the time to review all the investment options, do the research, reallocate your account on a regular basis, there's a set of funds called the Vanguard Target Retirement Date options that are built just for you. And what they do is they will create a portfolio that's going to be managed towards your retirement date. And as we were just talking, if we've got 20, 30 years until that date, it's going to be pretty aggressively invested, and it's going to have a higher allocation towards stocks. And as you get closer towards your retirement date, it's going to start to sell off those stocks and buy more conservative investments, things like bonds and money market. And it's going to do that for you on an automatic basis. So it's a nice, easy, do-it-for-me approach. And you'll notice each one of them has a year after it. So there's the 2020 fund, the 2025, the 2030, and so on, all the way up to the year 2055. And that would coincide with the year that you expect to retire or reach age 65. So if I thought I was going to retire or reach age 65 in the year 2042, I would probably go to the 2045 fund, or I could go to the 2040 fund. Just know that the 2045 is going to be a little more aggressive than the 2040. And if I felt like, based on the questionnaire that we took, that I was a little more aggressive, that 2045 fund would be the fund for me, I'd put all my money in there. And again, it's going to do exactly what you see here on this chart. In the early years, it's going to be heavily invested in stocks. And then as we get closer to that retirement date, it's going to become more conservative, and it's going to rebalance for me over time. Does that make sense?
Yeah, but their 10 years return seems to be quite low. Even though it's a target maturity of 10 years bucket, its return is only 5 point something.
Right, yep. What you need to take into consideration is what that 10-year period looked like, right? So we had 08, we had 09, we had, the markets were down 20, 30% in a couple of those years. So you look at that in an average, exactly, it looks a little low. You look at the 1 year, the 3 year looks a little better, right? That's the recovery period. So you may look at that and you say, gosh, that's really not going to help me achieve my goals, so maybe that's not the right fund for you. And so maybe for you, it's better to select some of these other individual options that have more risk tied to them, but they're going to give you greater return as well.
And we also need to compare with the savings rate.
Yeah.
1%.
Right, right. The biggest advantage on the 401k, as I see it, is your initial tax saving. Given your earnings are a little bit higher than these charts show, you're looking at state and federal, at least a 30% return on your money, just by putting the money in, and don't take a risk. Just put it in the money market like the bank. Yeah. So you're starting out 30% already better. Of course, when you take the money out in the future, you will have to pay taxes in it.
But at that time,
depending on tax bracket,
right.
We don't know.
Right.
It might be, theoretically, it might be lower, but it could also be higher.
Right.
But the advantage you have is the savings you're incurring by the taxes. Then you're speculating by investing in whatever you're comfortable. Most of the employees that we talk to are not into investment, and they give that away to the money managers. And they actually allocate the funds on a daily basis. They're working on those funds.
They do, yeah.
They're actually looking at those funds, which represent millions of dollars, and you're just one investor into that portfolio of funds, and they're managing the money for you. So they have a track record which gets to be evaluated if they're performing or not. Why don't you talk about the performance of the fund?
Real quickly, just one question. You mentioned something about loan feature not being available.
Right.
What do we not get by that being not available? Like, what is?
In some 401k plans, there's what's called a loan feature, which allows you to borrow a portion of your account balance, and then you repay it back.
Oh, I see.
So
it charges an interest for that money you're borrowing. So you're taking out your own money, but you still got to pay interest back.
So again, going back to the list of investment options, you'll see the returns there. And as Isaac was explaining, these funds have specific goals and objectives in investing. So if we're looking at the large cap value, so that BlackRock equity dividend, they're going to invest in larger companies. Again, those kind of Coca-Colas, those IBMs, those everyday Walmarts, those types of names. And because it's a value strategy, what they're looking for is companies that the fund manager feels are undervalued in today's market, right? That the marketplace is not fully recognizing the true value of that company, so they feel that I can buy it today at a discount, and at some point that true value is going to be realized and it will appreciate. Versus funds that are considered growth, Those are companies that the fund manager feels like they're on a trajectory up. They're going to continue to grow. They're going to pay regular dividends, things of that nature, so that appreciation is going to be there on a consistent basis versus buying something today that they feel is going to appreciate in the future.
One of the fund listed in this one is Transamerica Partners Stock Index.
Yep.
Is it a following index?
That's an S&P 500 index.
It's directly to that, or it follows the multiple indexes? Does it contain its own portfolio, or it just
mimics
to
the S&P 500.
And we can see the details of it, or?
Yep. So online, you're able to go in and see the top 10 holdings for all the funds,
okay.
And get detailed information. And this is just really a summary of right performance. Yep, exactly.
And this snapshot always has to be past performance.
Yes,
you cannot guarantee future results.
Yeah, it's a March 31st.
Right,
It's very far away from the today's situation.
Exactly. But yep, through our website, you're able to look at these on a daily basis. You're able to trade in your account on a daily basis. I wouldn't suggest that, but you have the ability. Yes.
Okay, there's my problem. Right, with these funds, we don't have any control, which is good, right? We don't have any control over where the money's going. But what if I don't like a company, like I don't like Exxon, for example, and how do I know that my money won't go there?
Yeah, that's a good question, and it's a little tougher. Most of these funds will disclose their top 10 holdings, so you can see what those are. But many of these funds will hold 200-300 different companies, and so if they've got a smaller position in an Exxon, that may not be as readily apparent. You'll be able to maybe get some historical information on where that fund is invested. Obviously the fund managers don't want other fund managers to know exactly how they're invested because they're trying to beat their competition, if you will. But if that's a concern, certainly maybe doing a little more research as to these funds, and again through our website you can get some of that detail. If you're looking to be a little more socially responsive, then you might want to take a look to make sure there's no companies that contradict maybe what you'd like to see.
Also, a company like Exxon may be a large cap, so you can just totally avoid that segment of funds and go to small cap.
Another great suggestion.
Very good.
Exactly.
You won't get.
The percentage will be very small.
Yeah.
I will tell you, it's a tough thing, and I talk to a lot of folks sometimes, and we do, there are socially responsive type funds that don't invest in tobacco, oil, things of that, firearms. The downside is those funds perform poorly.
As opposed to they probably don't look as much.
Yeah, so sometimes it doesn't pay. Other questions about the investments?
If you make a transfer from one fund to another,
Yep.
now is that transfer based on that day, based on the average amount that was taken in the previous period, or what?
Great question. Yep.
What
so
is the value?
Yeah. So you're able to trade in your account at any time. There's no trading costs. The other great thing about the funds that are in your plan is there's no front end or back end loads. So many of these funds, if you went to go buy them in the retail market, Schwab or E-Trade or whatever, you typically pay a front end or a back end load, so none of those apply. And again, there's no trading costs. Each of these funds get valued on a daily basis in what's called a net asset value, the NAV. So at the end of each day, they look at all their holdings and what the value is, and they divide it by the number of shares outstanding, and you get a net asset value, a price, if you will, for each of these funds. And so if you were to initiate a transfer today, and you put that in before close of market, we would execute that transaction at today's closing net asset value, or today's price, on both the sell side and the buy side.
And there is no fee to transfer funds either?
Nope.
Yes.
But this expense ratio is there.
The expense ratio is the expense ratio of the fund, right? Each of them have it, and it covers the portfolio manager's fees and expenses and all that good stuff.
That's mostly equivalent to the load.
Typically, in most of those, it's the load plus the expense ratio.
They get both.
They get both.
Right here. We net it out everything.
Okay, because like Fidelity and all, they normally, in general term, they just call it load. Everything expense is included in the load.
And there's also an expense ratio. So
Okay.
you may pay, let's say, a 3% load, they're also going to have an expense ratio ongoing.
Okay.
So that 3% typically gets taken out on your initial investment.
So this is the percentage, basically expense ratio. Every time I move from one fund to another fund, I pay that.
No, that's ongoing. It's an ongoing expense ratio in the fund itself.
Yeah, you don't actually see it taken out. These returns are net of the expenses. So as an example, you know, if we look at that BlackRock equity dividend, the expense ratio is 1.22. All of these returns are already net of that 1.22. And again, when the funds calculate the returns, they pull out their management fee, that expense ratio.
So NAV is already, NAV has already absorbed this.
Exactly.
Right.
Yep.
Matter of fact, when we were looking at Transamerica, Alan was reviewing that, that's one of the things he said, I don't want any fees or loads on these funds, because, you know, other places could design their portfolio with that occurring, but if this is really,
Monthly fee, there is no monthly fee.
everything what you see, and there's a disclosure by the government now that everything has to be transparent. So you can't, years
Right.
ago, they were doing things that you didn't know.
So we talked about, you know, why you should save in the 401k plan, right? The tax savings, we need to take control of our future ourselves. We talked about where to invest the money. The last really discussion is how much should you save? And, you know, most experts today believe that we all should be saving at a minimum 10% of our income. I know for many of you that thinks, gosh, how can I ever save 10% of your income? Start small, baby steps. For those of you that, you know, feel like, gosh, I don't know that I can even participate, 3%, if you defer 3% of your income, the difference in your take-home pay is going to be minimal. And the reason why is because that contribution gets made before any tax withholding. So now we're taking withholding on a lesser amount, and it kind of offsets your contribution. So if you even just start off with 3%, your take-home pay difference is going to be a few dollars. And you can build from there. And I would challenge you to do more. I would say start off at 6. But if you're thinking, gosh, I don't know that I could save, you know, even start off at 3. And then increase it 1 or 2% every year. So let's say you start off at 6% this year. Next year, go up by 2%. So now you're saving 8. And then next year, go up by another 2%. Now you're saving 10, right? And you did it in small increments. And you can do the same thing starting at 3, maybe going up by 1 or 2. And you eventually start to have a significant amount being saved on a paycheck by paycheck basis. And at, you know, the end of 20, 30 years, you're going to have, you know, a nice pile of money to help you save for, you know, live in retirement. So let me just, did you have the website up that we could walk through too, or not?
No, I
No,
didn't get it.
okay, no, that's fine. So how do you enroll in the plan? Everything's done online. If you go to page 3, you'll have our web address, which is www.ta-retirement.com. A little small, but it's there. And there'll be a first-time user register here button on the upper left-hand side. Click on that. You'll ask you for some personal information. You enter that. You get registered. Select your own username and password. And then you'll go through the enrollment process where you'll decide how much you want to save out of your paycheck and then where you want to invest it. And again, on page 5, you'll see a list of those investment options that we went over. And I kind of like this because it has option A, which is those target maturity kind of do-it-for-me funds, if you want to utilize one of those, or the option B, create your own portfolio. And again, you can kind of use this maybe to do some research, fill this out, and then when you go online, you'll know exactly which investment options and how much you want to have invested. From there, you're able to manage your account, look at it on a daily basis, make transactions on a daily basis. If you want to speak to someone versus just going online, you can always just pick up the phone and give us a call. We've got representatives available from 5 a.m. to 5 p.m. Pacific time. And anything you can do on the web, we can do for you over the phone. So if you'd rather enroll over the phone talking to somebody, we can do that versus you going online. Okay, just pick up the phone, give us a call. We'll, verify who you are and then help you get enrolled in the plan. If you ever want to move money from one fund to the other, again, you can do that on the website. You can pick up the phone and give us a call. If you want to take a hardship withdrawal, again, you can do that on the website. Pick up the phone, give us a call. You'll also receive a quarterly statement from Transamerica, and again, that'll just be for the snapshot at the end of each quarter. But again, you have the ability to go online at any time and run a statement on demand for a week, for 3 days, for a month, for a year, and it will look just exactly like the quarterly statement that we send you. We also show you your personal rate of return. So based on your investments and how you've done over that period of time, you'll see what your personal rate of return is. We also show you what your monthly income would be at age 65. So these are all great tools to help you kind of figure out, am I on track for retirement or not? And we also have a really cool tool called Retire Track, and it does exactly that. And I would encourage you to utilize this tool because it will give you a really great snapshot of whether you've got a sunny or a rainy outlook or sunny outlook. And we utilize your balance that's in the plan, and then you have the ability to add on to that, right? Maybe you have a spouse and some retirement savings there. Maybe you have some personal savings or an IRA. You can put all that information into this tool, and it will help you figure out, again, what your outlook looks like. And then you can run some what-if scenarios, right? What if I saved 1% more than I'm saving today? What if I got 2 percentage points more on my returns than I'm getting today? And that'll show you what that impact will be. And it's a really good tool to help you, like I said, save and plan for your future. So the other last item that I want to just cover here, and this is one of the most important, is the beneficiary information. That's captured online as well. Okay. So when you go through the enrollment process, we'll ask you for your beneficiary information. Make sure you put that information in there. I've seen a lot of folks not include that, or they don't update it. So make sure that that does get updated on a regular basis, especially if you have a change, right? Maybe you got divorced, married, whatever it may be. And then in this packet on page 7 is the rollover form. So if you do have a prior 401k plan with your old employer or an IRA and you want to consolidate your investments all in one place, you can utilize this form, complete this. Your financial institution, wherever that money is now, will also have some sort of distribution request form. Complete that. If you have any trouble or have any questions, need assistance, give us a call. We can kind of walk you through all of that to help you get that money over. With that, if there's any other questions, we'd love to answer them now. Otherwise, appreciate your time, and again, would encourage you all to participate in the plan and hope that you do.
Thank you. Thank you.
And anyone that's on the phone that wants one of these booklets that we've gone over the whole time, just go ahead and give me an email or Skype, and I'll send one to you.
Thanks, Amy.
Thank you.
Thank you.